There is no nice way to say this, but the British economy is not in the best place right now and looks to be in the midst of a major financial crisis.
A currency collapse, soaring borrowing rates, investors and businesses in despair.
Britain is now facing rising food prices, a worsening cost of living crisis and the prospect of a recession. Earlier this month, the Bank of England warned that inflation will climb to just over 13% this year.
Now, the British pound has fallen to its lowest level ever against the US dollar.
A warning from the IMF, central bank intervention, disorderly currency movements.
The UK is witnessing one of the worst economic crises in its history. Inflation reached a 40-year high, and the Russia-Ukraine war and Russian gas cuts have added more turmoil to the UK economy as the energy bills soared to almost 100%. On top of that, the newly introduced government policies pushed the pound to become one of the worst performing currency, and the bond market became chaotic. The Bank of England had to start buying up government bonds to stop pension funds from collapsing. Along with all these issues, the interest rate hikes by the central bank to control inflation might ignite housing and banking crises as well. Let's divide and conquer this video to understand the current situation. Energy prices are going up across Europe due to both post-pandemic increases in demand and the Russia-Ukraine war situation. The energy price cap introduced in 2019 puts an upper limit on how much energy suppliers can charge customers for electricity and gas. The cap is set by the UK's energy regulator Ofgem, and the energy suppliers' profits are already capped at 1.9% of the price cap. Many suppliers have already gone bust mostly because the cap prevents them from passing the rising wholesale cost on to consumers. The energy price cap in the UK has already doubled when compared to 2 years ago. With the cap introduced in April this year, the average household will pay an annual electricity bill of nearly £2,000, pretty much double the figure from April 2020. Rising wholesale energy prices and the administrative costs involved in bailing out bankrupt suppliers mean that the cap is expected to rise deeply in the months ahead and will stay high for the foreseeable future. It was predicted that the average energy bill will reach about £4,600 by January and about £5,300 in April. The government recently introduced an energy price guarantee. The guarantee limits the annual bill for a household with typical consumption levels to £2,500 a year for the next 2 years. Households will also receive an additional £400 reduction in their electricity bills, spread over 6 months from October to March 2023. The winter energy crisis is so bad that before any government announcement, many people have to cut down on energy use even to pay the bill, and will be left with no money whatsoever left to buy food and other essentials. The energy crisis is not limited to the price of energy, but also its availability. Based on stats from mid-September, Germany had about 220 terawatt-hours of gas stored up, Italy 170, France 112, and the UK just 9.8 terawatt-hours. Most European countries seem to be well prepared for the coming winter compared to Britain, even though Britain has less dependence on Russian gas. Governments of Germany, France, and Spain have introduced restrictions on the use of air conditioning and heating in certain buildings, with broader public information campaigns launched to try and get people to save energy, and the governments are trying to store up as much energy as possible. Britain has done little to try to reduce gas demand. This increases the likelihood of rationing measures and blackouts over the winter. Inflation in the UK reached a 40-year high, with annual inflation reaching 10.1% in July and 9.9% in August, and is expected to reach 13% this year. With inflation continuing to surge, the Bank of England has been forced to increase interest rates to try and get inflation under control. The idea is by making it more attractive to save and less attractive to spend, the economy slows down, reducing demand and therefore inflation. However, higher interest rates, along with a slowing down economy, make it more expensive to take out new debts as well as to service old ones like mortgages. Most mortgages in recent years in the UK come with 2 periods, the initial fixed and then the rest of the mortgage term. When you take out a mortgage, the interest rate you pay on the loan amount is typically fixed for the first few years, And during that time, the interest on your mortgage won't change regardless of what the market is doing. After this initial fixed interest period is over, the mortgage reverts to a variable rate which mirrors changes in interest rates. So if the Bank of England hikes interest rate, then your mortgage payments go up. So interest rate hikes affect existing mortgages as well as make it harder to get new mortgages. When interest rates are high, the initial fixed period has a high rate for new mortgages. One of the big lenders, Nationwide, increased their fixed rate offers with a 2-year fix rising from 2.54% in June to 5.59% in September, while the banks such as HSBC, Halifax, and Santander have all suspended new mortgages entirely. This will force more people to sell their old houses because they can't afford the increasing mortgage payments, and at the same time, fewer people will buy new houses as they cannot afford to take out a new mortgage. 3/4 of homes in the UK are purchased using a mortgage, and as the supply increases and demand decreases in the housing market, prices will fall as well. Falling price is a good thing in some sense. House prices are way too high all across the UK and have already hit record highs. However, current trends might create a too sharp fall and will be bad news for the entire economy. Banks will run into trouble because mortgages make up a large percentage of their business. If the value of your house falls below that of your mortgage, and then if you default on your mortgage, the bank has to take a loss. This will create a 2008 financial crisis-like situation. A full-blown housing crisis is very unlikely at the moment, but it depends on the steps to be adopted by the central bank and the government of UK. That brings us to the next section. The UK is growing at a lower rate for many years. Lower GDP growth means less tax collection and lower government revenue. And to make up for the losses, the government has to raise taxes on the public, which in turn reduces consumer spending and affects GDP growth. UK economy was stuck in this loop, and the newly elected Truss government wants to break it by lowering the tax rate. The government announced a mini-budget which set out the government's growth plan with the biggest tax cuts since 1972. The idea is to give more money to the hands of people and encourage spending. But this is in contradiction to the efforts already put forward by the Bank of England by increasing its interest rate to a 14-year high, thus discouraging spending to get inflation under control. The energy price guarantee and the tax cuts policies were heavily criticized as researchers pointed out that the rich are going to benefit the most from both these policies. And they are inflationary. These policies will increase government expenditure and decrease its revenue. The energy price guarantee is expected to cost the government £100 billion for the first year, and the tax cuts will cost additional £45 billion. All these lead to a lack of faith in UK currency, and the value of the UK pound declined. Also due to more debt-driven policies and depreciating currency, UK government bonds faced less demand, and bond interest rates rose. Because government bonds are seen as low risk and low reward, many pension funds like to hedge against interest rates. In a way that means that if interest rates increase, pension funds have to pay up. And as the interest rates climbed, pension funds had to find a lot of cash. To raise cash, pension funds started to sell assets, mostly government bonds. With less demand and a drastically increased supply of government bonds, the prices started to nosedive. Bank of England had to step in to control the chaos and announced that it would carry out temporary purchases of long-term government bonds worth of £65 billion. The UK's central bank had to step in to protect the UK from the actions of its own government. The UK is the world's 6th largest economy by GDP. But what happened in September shows that the UK is in a serious financial crisis of its own making. Due to the energy crisis, Britain might not have enough energy for this winter, and if there is enough, it's still very expensive in every way. Inflation is already high and is expected to take at least 2 years to get under control. As of making this video, the UK market is looking for headlines related to the possible reversal of the tax cut policies by the government, further interest rate hikes by the Bank of England, and end of temporary intervention in the bond market. There's no doubt that the economy is heading to a major crisis. The government and the Bank of England must come up with some big plans to tackle all or at least some of the major issues to avoid a severe crisis.